Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn with Focus Compounding, on air live with Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great with everybody else as well. If this is the first time you are tuning in with us, thank you so much for joining us. Be sure to check out all of our content on the internet. Go to focuscompounding.com to get access to investment write-ups from Mr. Geoff going all the way back to 2005. Follow me on Twitter at @FocusCompound to get access to all the content that we put out into the investing universe. I'm also tweeting all the time just different pieces of content that I find interesting. So to be able to find me on Twitter, go to @Focused Compound and hit that follow button. If you're watching us on YouTube, hit the subscribe button. If you are listening to us on a podcast app, hit that subscribe button as well. A rating and review goes a very long way. So if you want to support the cause, you'd like to support Geoff and myself, perhaps you've benefited from our work, a rating and review goes a long way. If you're interested in learning about our money management services, you go to focuscompounding.com, hit that Invest With Us tab right here, and you'll get everything that you'll want to know on that. We have our deck, which goes over our fund and managed accounts, and you could get access to that. We are a long-only equity-focused hedge fund in Dallas, Texas. We are focused on identifying high-quality companies in pockets of the market where large pools of capital, like mutual funds, hedge funds, pension funds, cannot or will not consider or invest. And we believe that fishing in this pond presents an opportunity just to find more stocks that are off the beaten path and hopefully more undervalued because they're not followed by the general market. To invest in the fund, you do need to be a qualified investor. Our minimum investment is $2 million, no management fee. We take 15% of the profits with a high watermark, and the managed accounts are for everybody else. The investment minimum is $250,000. We don't take an incentive fee, and the management fee is 2.5%. With no high watermark and basically daily liquidity because it's your account. It's how they interact with brokers. We are just the managers on the account. So in today's podcast, we are going to be going through a lot of stocks. I did a call for stocks on Twitter. And Geoff, it's kind of funny. So normally when I do a snap judgment call for stocks tweet, I get a zillion different tweets, because I think people are just putting in like every single stock that they're potentially interested in. But today I added one extra sentence that says, name a competitively advantaged stock with a less than 280 character elevator pitch. I want people to tell us why they're interested in it. What's the pitch? And interestingly, I think it really filtered out a lot of people that usually just spam the tweet thread with a bunch of different companies. So we will go into that in a bit. But before that, we could hit on the markets and everything that's going on here today, December 7th, 2022, where we currently sit. The S&P 500 is down 16% year to date. The 10-year yield is at 3.408%. Crude oil, $72 per barrel, and natural gas, 5.838. Energy has really come down a bit over the past few months, as well as the 10-year yield as well. A major development, Geoff, that I would love to get your opinion on since our last podcast is, I'm going to call him by his government name, Robert Iger. Mr. Robert Iger is now Disney's chief executive officer. So that took, I think, the whole financial community by surprise. Pretty incredible. For those that do not know, Bob Iger, he was the CEO for 15 years. What was it? 2005 to 2020. He was the CEO after Michael Eisner. Under his leadership, and I'm reading from his Wikipedia page right now, they acquired Pixar for $7.4 billion. It's actually a beautiful story. If you read his his book, what was it? The Ride of a Lifetime?
Yes. Yep.
Beautiful book about when Steve Jobs and him sat on that bench, and I think Steve told him that he had cancer and that he wanted to sell his business. So under Iger's leadership, he bought Pixar, Marvel Entertainment. What else did they do? They signed a deal with Lucasfilm. Yeah. So lots of M&A under his leadership. And first of all, I want to get your opinion on like this whole, I guess you could say like, new development of Bob Iger coming back. I mean, I felt like he stepped down as CEO because I was like, is this guy going to run for president? Is that why he is stepping down from Disney? He, has since said that he wants Disney to stay out of the politics. It sounds like he thinks Disney Parks is charging too much. There's a couple, sources on his opinion toward that. So I'm just kind of curious to hear your sort of snap thoughts to Bob Iger now being the CEO of Disney again.
Well, it's interesting because a lot of the things we've talked about with the company are things that he kind of put in place, right? So just carrying out strategy that are big strategic things that were in place when he left, at least. They basically already had Disney Plus as an idea going pretty strong. And they followed through with the strategy that they had and pretty much the almost guidance or whatever you want to call it about the timetable of when they would make money and how big it would get and everything. So that's pretty similar. And then he was at the company for a very long time and is now coming back. Disney's, read that book, Disney War. They've had problems with this kind of thing before. I think he probably didn't really want to leave. So that's part of it. And it seems like it may also be as much personalities and things like that as it is strategy. People from the outside looking at it, shareholders and analysts and everything, try to come up with the idea that he's going to have a very different strategy, which he may have because you don't bring someone else in unless you're planning to do that, obviously. But I don't know that's the reason for why this happened. I mean, you're bringing back someone that you had before, which suggests that, maybe he didn't like being retired as much as he thought he would. Maybe people on the inside didn't like the Bob Chapek, the CEO, as much and didn't have another name of a different person to put in place. And so going back to who you had before was kind of the only way to do it.
What is it with this damn company and their weird personalities? Like, what is it? Is it because it's such a powerful company and you're sort of in the spotlight? You're involved with Hollywood. You're also involved with investors in business. I mean, what is it?
Well,
it seems like very ego driven.
Yeah, I see what you mean. Yeah, that's possible. If you think about it, between Eisner and Iger, you had, 30 years, 2 CEOs, something like that. A little bit more than that total. So, part of it may be that, if you have people that are the same age and get passed up or something because the tenure lasts so long, that can be a problem. GE had some top people who they lost because they made a decision to pick one person and kind of everyone else you pass up, you lose as a result of that, GE's case, they actually told them they had to leave if they didn't get the top job, but same sort of idea. So maybe if you have more of a sort of succession plan, that's normal that way. The other thing is you don't have large shareholders or large founding ownership or anything, and you haven't in the company for a long time. So from the Eisner years on, the Bass family had some with the example of with Eisner going all the way back there, but generally you don't. So you do have this thing that this is an independent company. I mean, Comcast tried to buy them, and there have been other cases a long time ago, but it's basically this very large company that doesn't have much of a base other than the people managing it. So it is purely an issue between these people who don't own a lot of stock in the company and who, are the board and management that are fighting over it. So, that way it is similar to like a GE or something. Because a lot of the other companies we talk about, right, on this podcast, the really big companies today, many of them have some sort of either whether it's dual class or still a founder involved or still major shareholding. Disney is a much older company and hasn't had that for a very long time.
What are your thoughts to what he said about him believing that the pricing of their parks has just gotten too expensive?
Yeah, I don't know. They said a few things, and some of them sound fine, but I don't know what they really translate into and what they're going to do. Talked a little bit about creative things, wanting to put more control in the hands of people who are creating things, meaning more decision making there, as opposed to what they were doing as a more centralized thing at the company. The parks thing, I don't know exactly what that means. They're somewhat limited in terms of like, there's just a certain, parks are built for a certain level of capacity. And so in terms of monetizing it, I don't know that you can come up with much better ways of doing it. They may be able to come up with some, and I think they've might consider some.
You mean
things.
like if a park is like super packed, the way that you sort of combat that is to raise the prices or have pricing mixes, maybe less during the week, more on the weekends, stuff like that.
And they just raised prices, and for the first time that I can remember, they raised prices differently for one park in Walt Disney World than from the other ones. So Magic Kingdom was raised more. Magic Kingdom has overcrowding, so that's why they did that probably. And then some of the other factors are, since COVID, they've had different policies in terms of they haven't been selling season passes. They've cut hours. They used to have hours before or after having a park open sometimes for things, and some of that stuff's been cut. So, but that's typical of a lot of companies, right? That there's just, they didn't change their actual operating hours, but I think with a park, you do have that problem no matter what. You can't really, I'm not sure you can do a lot more to make it a lot more affordable. Unless you're going to add capacity, right? Or figure out some other way to do that. But I do think, that's obviously been the way that they've made a lot more money over time. It hasn't been such a big increase in attendance. Since the 1990s, that's been the really big increase for Disney. So Animal Kingdom, Walt in the U.S., Animal Kingdom was over 25 years ago now, and then since then, it's mostly been gains in a lot of the... in particular, a lot of lodging, but also gains in terms of like adding alcohol and some more expensive food things and stuff like that too.
What are your thoughts on Bob Iger's previous, I guess you should say, tenure as CEO? Did you think he was a great CEO? How would you evaluate his performance, after the fact? If you were looking at Disney right now and trying to get comfortable with him, being CEO currently, what are some things that you'd be looking for? Would you be looking, a highlight right here on QuickFS, or, the spreadsheet from QuickFS when he, took over as CEO 2005, and then when he stepped down as CEO in the 2020 timeframe. So, what are some things that you would be thinking about? And do you think he was a good CEO for Disney? Seems like he took a much more M&A approach to the business.
Yeah, I think he was okay. I think the problem with the M&A and everything is that it didn't necessarily add a lot of value given the prices that they paid for things. But they were good strategies for them to take, and they could have done more even in that the things that are more synergistic with the company and everything is not stuff like ESPN and Hulu. And it is stuff like what they bought with Fox to some extent, but also especially Lucasfilm, Marvel, and Pixar. So I think that made a lot of sense for them, and that's something that they can do more of throughout their whole organization. That there's a real benefit from owning those things. But the company's, by most measures, I would say, it peaked about, 7-8 years ago in terms of, I guess its operating profit rose a little bit beyond that point, but by a lot of measures, we're talking about, something in that neighborhood. In terms of many of the kind of measures that we would use, whether it's, margins or returns on equity or whatever stuff. It really isn't, it was several years before he left. So, and some of that is associated with the, the move to streaming, and they had to take things off because they didn't want to launch Disney Plus without having a lot of content for it. That meant taking things off of deals that they would normally have. I don't think monetization of this stuff is as good as it used to be. So I think all that stuff's really difficult. So, I think he was fine. He was the CEO for a long time. I read the book. I read Disney War as well. I don't think his time there was as good as the early years of Eisner. Well, but he had other people around him at the same time, Wells and Katzenberg and stuff then. But I don't think it was as good as that. I don't think it was as good as the years under Walt. But it was a pretty good period overall compared to some of the others that they've had. So, the M&A was pretty expensive. So it was good stuff for them to buy, obviously, but it was pretty expensive. And some of it, is really good, and some of the other stuff I don't know. I mean, like, what part of the problem now is they're spending a huge amount on Disney Plus, and also Pixar. Is it worth a lot now anymore? I mean, since COVID, they haven't had successfully released major films in theaters using Pixar, and so the Pixar brand has definitely deteriorated a lot. Disney Animation released a movie that was probably is going to be adjusted for inflation. I would guess their worst performance in the history of the company. So Disney Animation is the oldest part of the company, and Strange World, the movie that they came out with, will end up, I would guess, adjusted for inflation, as about as bad as anything they've ever released in terms of how much they lose. I wouldn't be surprised if when they tallied up, they say they lost $150 million on it or something in that neighborhood before taxes. So certainly more than $100 million. They're I think they could do some more M&A stuff. And, obviously he did a lot of that and he was successful that way. And later on in his tenure, he was certainly well-liked, publicly, and was a good face for the company that way, compared to what they've had these last few years. That wasn't as true in the beginning. I don't know that he was universally well-liked and stuff early on, but he certainly was later on. So, because he didn't have a background that was some big creative background or anything. So, the idea that he's replacing someone and then he's going to put creative stuff front in the company, that wasn't what he was at the beginning of his time there. But, they feel that way now versus who they have. So, we'll see. I don't also, he's a lot older and everything, so I don't know how long he would last as the CEO before they'd start thinking of getting someone else in there. So, yeah.
What type of M&A could they do? What would be the right direction?
Well, that's the problem. I think in terms of like antitrust and all that, and just like political pressure and stuff, they're in more of a problem area. This has become a lot more politicized. I think a few years ago, they could have done more to maybe swap assets or do sort of deals that would have allowed them to get out of some stuff that I don't think they needed to be in as much, and to streamline more around the content that they have. The reason why like owning film studios is good for Disney is because they have a really strong parks and consumer products business that gets a lot more money out of those movies. So when you have a hit, they make a lot more money from that. I think there's some of the stuff that they have, the company's a mix of a few different things, and I don't know that the TV networks, which I'm including in that things like Hulu and Disney Plus, are as good businesses for the long term. So ESPN, Hulu, and then the cable networks and network that they have. And they also own some affiliates. So, I don't know if those two businesses need to be together or anything like that. So that's not a problem that's unique to them. I mean, it's also a problem that like you see with Paramount and some of the others have a mix of things that I'm not sure need to be mixed together that way. But they probably could have done stuff that was better that way. But he wasn't really someone who disposed of stuff and streamlined it. So, and the things he bought were really good assets, but, you paid a pretty high price for it and everything. So, and Fox was really the only hard fight that way in terms of getting approval for it, and that other people might have wanted it and stuff too. The others were more natural fits with Disney. So we'll see, but I just think that it's a tough industry. And while part of Disney is probably easier to run that way, there's another part to it that I don't know as much about its future. So, I don't think the future will be as, ESPN and some of the other things I think in the world that we're going towards with streaming is not as valuable as what it used to be. Whereas, But I also think to some extent it depends on. I think Disney Plus, if they had changed things how they did it, could be as valuable. If Disney Plus was a place to have things after their initial run and they weren't making a lot of original content for it, I think they could do well with that. Right now, just like the others, like HBO Max, it's so costly because they're not monetizing the content that they put on to the same extent that they would by having a run in theaters and then and then having it on the service. So we saw that with Netflix did a week of Knives Out, the sequel to Knives Out. And it did a lot worse than it would do if it was a theatrical release without being on Netflix. Now, Netflix's goal is to drive a lot of people to sign up for Netflix, so it'll do what they want. The whole point was just to create buzz by having it out for a week. But that's an interesting one because it shows you them using a movie that actually would have brought in a lot of money and not monetizing it that way. So it shows you how expensive the content is that way. So, I mean, I think they really have to rethink their strategy here, but this is not unique to them. It's the whole industry. So,
How do you judge a CEO? And the reason I ask that is because when you were just describing Bob Iger, you said, yeah, he was fine. And I kind of laughed when you said that because on one of my questions I had written down, I said, qualities of CEOs. And then I said, great, ? And then I put in quotes, fine, next to it, because I don't think I've ever heard you say that a CEO was a great CEO, maybe outside of Buffett.
Right.
And you're always just kind of like, yeah, it was fine. Because you can look at this, and that's why I laughed when you said fine, because I had that written down. But okay, so net income was 2.5 billion. When he retired, it was 11 billion. EBITDA was 5 billion. When he retired, it was about 16 billion. You could even look at the stock price. The market capitalization was 47 billion, and when he retired, it was somewhere around 224 billion, while paying dividends along the way. So I'm kind of curious to hear, in your mind, how does one get on the great shelf in your mind? Like, what makes a great CEO when you're looking at what they've done?
Well, yeah, I mean, I guess, let's see. Yeah, I mean, they did have a period where, you're right, in terms of net income and things like that, right before he left, it was pretty good. I think the record was good. But I also think, well, I don't think he was dealt a particularly bad hand, though. So that's kind of the issue here, Yeah, I think that's more my issue. And maybe I should say good, not great. So I shouldn't say fine. I mean, it depends on what your standards are, right? I think he was good. Yeah, I think he was good. We can say that. But I don't think it should be hard to find a good CEO for a company like Disney.
Sure.
They're very well compensated. It's a high profile job. They let him stay in the job for like 15 years. So the guy who came before him was also in there for a long time that way. It's not like it shouldn't be that hard to bring in someone who's good. But yeah, I think he was good. I don't though think that he I don't know that the record would be incredibly different if it was someone else. Now the M&A might be different. I think it was a big improvement on Eisner, but I think that was more an issue of just like someone who had been there too long. If you have a certain kind of personality and stuff, if you stay long enough, there's no one left in the organization to kind of that you need to help you out that way in terms of just not just agreeing with you and everything. And I think that happens if you stay too long in some companies.
Did you think Michael Eisner was a great CEO?
I think his very, very early record was great. But it's tricky with any of these too, because I think we probably attribute too much to the CEO. Right? How much of this was so the CEO here, right? He acquired some things, okay? And we give him a lot of credit for that. Okay, you acquire Marvel or something. But is it perhaps the producer in charge of Marvel studio that really deserves the credit for that, right? I mean, but he, you're the CEO, so I mean, you get that credit too. I mean, should we give Buffett a lot of credit for the insurance business when it's really Ajit Jain, and before then they had a lot more trouble? I don't know. You brought him in and you gave him the tools to do what he needed to do. But I think there are other people in an organization that are important too. So, and the CEO who he just replaced was running the parks business. So, I mean, that's also the question with Eisner, right? With Eisner, he wasn't running Disney in it. Disney as a studio, the movie studio, not just the animated studio, but the live action. So it was really successful. But did he do that, or was that? Should we give that credit to other people? So no, I mean, I think Iger was good, and I think that Disney's performance during that time was good. The stock wasn't that cheap when he came in and stuff, so the stock performance may not have been as good as the financial performance. But although the stock performance at the end was pretty good because it started to get very expensive. The stock probably peaked right when he left, or the market overall was peaking about when he left. Yeah. So, or at least the market for the streaming companies and stuff. If we put peers up against it, it would look pretty similar that way. Yeah, but I don't think he's irreplaceable or something, and I don't think that people should think that him coming in solves the problems. I think that him coming in, they're dealing with the same exact strategic problems they had before. And this is not unique to Disney. I mean, I think Discovery and Paramount have it at least as bad or worse. I mean, Discovery, I think, has been pretty serious, the problems that we've seen there.
So how would you be thinking about this if you were a current shareholder of Disney?
I'm not too positive on Disney, Discovery, Paramount. Right. I don't think their prices on an enterprise value basis are all that low compared to what they're dealing with. And while I think there's a part of Disney that's really good, the other part I do wonder about more. So the part that I wonder about more is the stuff that we've talked less about, but the non-Disney branded stuff, basically.
It's like the ESPN.
Mm-hmm. So I mean, I think the movie studio, parks, the Disney Plus streaming service on its own, those things are strong. But when you're talking about ABC, different cable things, ESPN, Hulu, yeah. I don't know. And when you're combining, I mean, Disney also financially is in a much better position than some of the others. It can afford to do what it's been doing with Disney Plus. Some of the others, there'll be some credit issues and stuff if they don't improve their cash flow situation that way, because they don't have quite the park situation that Disney has, for instance. So they can't, and Disney, compared to some of the others, borrows significantly less relative to sort of its economic value. But yeah, and I don't know what they'll do about that, because of course if you spin things out or separate things and stuff, then you become a target, and I think they're all probably worried about that. So I think that the more you break up pieces of the company, the more that you become an attractive target for people to whether it's just activists or people to actually buy to try to bid to take over the company and stuff like that. So I think they probably don't want that.
Interesting. Always interesting to hear your thoughts on anything theme park related. So before we jump into our snap judgments, I wanted to spend some time talking about this question right here. And that is, what makes the perfect stock? You had written an article on focus compounding where you said, don't just over maximize one variable. And you went in to talk about how throughout your investing career, you had wished you didn't focus so much on things that were either incredibly cheap, all things being equal, or things that may have been like very high quality. And you had spoken about a stock may be clearly expensive at 24 times EBITDA, ambiguously priced at 12 times EBITDA, and clearly cheap at 6 times EBITDA. Does that mean you should like it even more at 3 times EBITDA than at 6 times EBITDA? If it's the same business at the lower price, yes, of course. Other things equal, cheaper is better. But other things are rarely equal. And the argument that the same business priced at 3 times EBITDA instead of 6 times EBITDA is a better buy doesn't translate into an argument for starting with the stocks priced at 3 times EBITDA instead of looking at those priced at 6 times EBITDA. If the business is good enough, the management honest and hardworking enough, your knowledge of the industry deep enough, etc., and it's priced at 6 times EBITDA, that's probably enough. Often you may be compromising more than you think on the other softer variables to maximize the hard variable of price. So because we're always looking at stocks, every single episode now we're pulling stocks to look at, I want to spend some time basically asking you, like, what is the perfect stock? What does the perfect stock look like in your mind? And it's so hard because every situation is different. It's not black and white. But what did you mean by this when you had said, don't over maximize one variable, focus on many different things? And in your mind, what makes the perfect stock before we go and spend some time looking at a few different businesses?
Yeah, I mean, I think number one is good product economics. So a product that kind of sells itself. So we've talked a little bit about how you often see, and this is hard with large companies, you can't kind of break it down as much by units and product lines and all that. But what you would see is constantly rising sales, gross profit, and operating profit. You'd see stable and pretty high gross margins, and you wouldn't see a ton of variability in those things. So just a lot of signs quantitatively of the strength of a product, so like Apple's iPhone is a strong product. It has good product economics. That's easy to see because the company consists of some other things, but not a ton of other things like Disney where it all gets obscured, right? So that's one part of it. Then you'd also want capital allocation, which, usually for me is capital allocation into more of the same thing, right? So taking the Disney example that we just did, that's part of the problem, is that as much as you might like what's happening in the parks or whatever, let's say that 50% of the EBITDA generated there goes back into that kind of stuff. That means the other 50% has to go into other parts of the business, and you just don't know as much if the economics of those are as good, right? So we need some sort of thing in terms of capital allocation that gives you faith that way, which the best is if it can actually reinvest in organically growing the business. But other things could be, it could pay it all out in dividends or buy back stock. And then we talked about management. I would say like more organization matters more to me overall. So maybe that's why I never say, that he was a great CEO or something. The overall organization, that they're capable, some sign of that. And a lot of times the company is very successful with an organization that's maybe not that capable because the product or whatever initial advantages it had is so strong. And sometimes it's the opposite, where the company's only successful, marginally successful even, because of how great the organization is, because it's in a tough situation otherwise. But what you would want is some feeling that the organization is capable and that you have great kind of product economics. And then in terms of price, you want a lower price. So lower price is always better than higher. But, if it's 12, 13, 14 times PE, that's not a big deal. I don't even think that, I think I've said before, I don't think that obsessing over whether something is 13 times or 19 times is really that big a deal. 13 to 19 is not, for many businesses, obviously an incredibly cheap in all cases, nor is it obviously an incredibly expensive. So it's kind of a range that you have to assess the business more to get an idea. You do want cheaper, and the better you understand the business, the easier it is to tell how cheap it is. But I wouldn't worry too much about like exactly figuring out what's the perfect right price, just like I didn't say the gross margin has to be exactly this or whatever, right? In the case of Apple, which I said was a great business, actually the gross margins aren't incredibly high. It's only with tremendous scale that the gross margins are able to convert into a really good operating profit. The same thing's true for a lot of branded food companies. If they were really small, I don't know that their economics would look that good. I don't know that you could have like a niche version of the iPhone or something that would be really successful. It's only at huge scale that it looks amazing in terms of generating profitability that you see that way. Whereas a lot of businesses never get to that size, and so they need to have better economics further up the income statement stuff. They have to have better economics from the beginning because they're never going to be selling 100 million of these things or whatever.
So when you talk about judging the organization, are you talking about judging the culture?
Yeah. So so when I say organization, I mean major shareholders, the board, the people who I think are key, who could be the CEO, could be the CFO, could be the head of certain business units, depending on the company, could be the founder if they're around, or a large shareholder or whatever. It's different in each company. And kind of what I was saying about the Disney thing is that, so when someone is in for 15 years, whether it's, someone like Eisner or Iger or whatever, at a company like that, basically you end up with them sort of naming everybody who's at all the key points in the company, including the entire board, basically. So it's as if you have an organization that is like mostly reflects them in a lot of ways. Not true of all companies, but it's true of a lot. And that's not true usually when someone takes over for someone who's been there a long time. And so it really does change what the organization looked like. So like Disney, the organization, when Eisner came in and stuff, improved in terms of bringing in people who from the outside, a lot of people from the outside in high level positions, who did good things over the next few years. So it could mean the heads of like business units and, a lot of things like that. It really depends on the organization that we're talking about. It's hard to say because a lot of times when we're talking about very big companies, you don't have very good insight into this kind of thing because they're so big. Mm-hmm. Yeah. And there's so little that you can know. So the key personalities, the strong personalities there, and it matters differently in each organization. Each company that we look at, I think you can see that there's different people who are clearly important. And it changes over the course of the life of that company, who those people are. It is, the assumption in kind of the media in the U.S. and stuff is definitely that it's in the last few decades at least, is that it's the CEO that is everything. It depends, but their tenure isn't necessarily all that long sometimes. And sometimes there are other people that are very important to the business. So it really, really depends on how the business is organized and who has what sorts of authority over different things. And I think the sort of the overall strategy that we're talking about is also an important part about that. So like what the and I guess that's what people call culture, I don't know. The culture thing is always a hard one for me at exactly what that means. But I think when analyzing the different organizations, we could say some things about it. So like, what do you come across good and bad that you see a lot? One is definitely Buffett's talked about like institutional imperative. I'd say one is a lack of ability to administer, like to actually get done the things that you say. That would be one of the most common ones that you see in organizations. So they can present in a presentation, here's what we want to do, right? But if they have a hard time actually carrying out those changes inside their business, then it doesn't really matter. And that's one that you see very, very common in organizations, in businesses. And that's one that takes sometimes a very strong-willed person or a very special kind of organization to be able to implement changes quickly. And so that's the kind of thing, like, take M&A stuff. That's something that someone at the top can really do and can change easily. But there's other smaller things that is very hard for them to change. The stuff that, Howard Schultz going back to Starbucks, over and over again. Many of the things that he want to change are actually very hard to change in an organization. And once you drift away from them, they're hard to implement those kinds of changes. But they're key. So I would say that's one of the top ones that we see. So like in ineffectiveness in carrying out changes that customers and things, frontline stuff would see. In inability to eliminate cost creeping up, how cost conscious is the culture. So when we talk about culture, how cost conscious, how risk averse, how entrepreneurial, how highly incentivized. Those sorts of things.
Mm-hmm. Yeah. As investors, we're always battling between, the price you're paying and what you're getting for that price that you're paying, right? And the relationship between the price and value and trying to buy something that you think is undervalued. Sometimes I think about, do people just complicate it, right? When you look at, this reminds me very much of Buffett's investment, the way that he described the Washington Post. And it says in 1974, this is Buffett speaking to, I believe, Notre Dame MBA students. He said, in 1974, you could have bought the Washington Post when the whole company was valued at 80 million. He said, if you ask any one of thousands of investment analysts or media specialists about how much those properties were worth, they would have said, if they had to add them up, they would have come up with 400, 500, or 600 million. And he goes on to say, it's not that complicated. If you're paying $80 million for a company in the market and you think it could be worth 400, 500, or 600 million, that is sort of like the 2-foot hurdle that he always talks about instead of like the 10-foot leap. So I wonder, do you think it really comes down to patience and waiting for the opportunities like this? Or do you think opportunities like this just don't really exist anymore in the market? I mean, this was 1974.
Right. No, I mean, I don't think they exist that much in the market today, but I don't think they existed a few years before 1974, and they didn't exist about 15 years after when, the multiples on media companies were incredibly high. Obviously, it was a really, really bad period in 74 for stocks and for media stocks and for advertising stocks and advertising supported media. That's the worst year. So 73, 74 is a really bad time in the market, about as bad as in the Great Depression. There's no other time that's as bad. So if we have a period that's really bad that way, then yeah, sure, that could happen. I'm sure that happened with some stocks after technology things, after the .com busted, or after I'm sure there were things that were incredibly good deals in the middle of the COVID crash, so yeah, that was an industry that people didn't want to be in at the time. So I think that does happen sometimes. Sure. The best thing is when you can find a stock where you think as a private business, it's more, if you valued it as a business, you think it's more that people don't like it because it's a stock, basically. And that was the situation there. You weren't going to get, now you couldn't get control of that company. That's part of the key part to keep in mind too, though. Though a lot of people might have been buying that company if they thought it could be put in play or something. It couldn't be because the Graham family had the B shares. Whatever. They had the super voting shares. Look, Facebook got very cheap and stuff. And maybe if someone thought, you can put it in play, then it would be different. But yeah, if you have something like that, then sometimes they do get very cheap. When there's a lot of concern about that industry.
Yeah, look at Facebook, 10 times earnings, EV to sales, about 2.3, EV to free cash flow 10 times. And you look at it, this is the type of company that we would love to see, that we're looking at. But of course, how much of the earnings is going to be the same going forward. And there's a lot of people worried about a lot of things with Meta platforms and their spending and stuff like that.
Right. And this is where I get into the thing about the product economics. People ask about Meta. I'm unlikely to ever own it just because I've never really understood the product economics well enough in terms of what drives it. I think a huge part of it is the effectiveness of the advertising. We talked about that a little bit. It did become an incredibly popular platform. It would have made a ton of money no matter what. But if it as ultimately an advertising business, and it's very important whether that drives results for the advertisers or not. And I think it was a particularly impressive way of advertising. We talked about this with Twitter. How is it possible that you can have such a large audience and not really be making money? Well, it's possible if your ads aren't very effective. And so that's something that requires a lot of research into why aren't your ads effective, and to talking about to people who know that kind of thing, and here to talk to people who know about advertising things online, but also privacy things and all of that kind of stuff, and how these work. Whereas I feel like, for instance, with Disney, and I could be wrong, but I feel when I talk about it with you here that I do understand the product economics of a movie better. And so I do feel that I understand when Disney or Warner is doing these things that it's very costly since COVID, that there's no way that they're monetizing anywhere near the value of these movies under the old way of how you would release them. And it's perhaps a lot more costly than people realize. What's actually been like what content has been shifted over to streaming things in a way that you've foregone revenue that you would have otherwise gotten around the world through box office and through different windows and stuff. And it just really, really expensive. And if I felt I had as good an understanding of the online advertising business as I do the movie business or something, then maybe I would be very excited about Meta, or maybe I'd be completely saying, no, I won't touch it, but I would have a stronger opinion one way or the other. But I don't feel I understand that business as well.
Mm-hmm. Twitter's an interesting one. I mean, pull the tapes. I did say on one podcast that I feel like we'll look back at Twitter one day and say, wow, wasn't that a bargain in plain sight, or wasn't that obvious in plain sight? The presidents and diplomats in different countries, everybody communicates on Twitter, and it's really just like a business issue, an operational issue. Isn't this, the product is so great, isn't going to be obvious one day when someone comes in and fixes it? Now, did I think that it was going to be Elon Musk and that he was going to buy out the company? No, I don't know if anyone foresaw that. But it always looks obvious in hindsight. But I did say, I feel like one day we're going to look back and say, wow, wasn't that obvious? We've talked about Twitter so many times on the podcast of, look, you have their revenue go from, in 2012, 317 million to 5 billion. And you have their net income basically continue to go down, and shares outstanding go from 117 million to about 800 million during that period. I mean, just horrible, Yeah,
if it wasn't for the financial aspect of it, look, the price on it and the fact that it's not very cash flow from operations generative makes it a terrible LBO. But as a turnaround target, it was clearly very, very attractive. I don't know if we talked about this or what. I think we may have even mentioned this. I think it would be a target that other media companies would like, except they felt it's too dangerous to the rest of their business. Mm-hmm. Whether you're, Disney or Warner or whoever, was never going to do this because mm-hmm. it could have severe backlash against all sorts of things across their organization. It could have their own employees quitting on them and stuff, So that it's just such a political hot potato, right? So, but there's stuff that could probably be changed and to make a lot of money off of, and probably being private would help with that. Obviously, this is one of these where we talk about the organization, the things that they did over that time, like you said, it just, that's where you kind of have a concern about this,
Yeah, and even text messages were released, I think, between Elon and Jack or maybe Parag, and he basically said, like, it's too hard to do this with Twitter being a public company. It's too hard. If you're going to go in and slash all the bots, and that's going to, say, oh, your user count's going to go down or whatever. Yeah. You just can't do it as a public company. So it's definitely a business that you need to clean up more, being private. And Elon's probably the best person to do that because, like you said, who would want that, hot potato?
Right. And who else would, like, he has a Tesla and stuff. I mean, most companies wouldn't let you do that, basically, mm-hmm. Maybe Bezos with the Washington Post and all that, but most would be like, no, you can't buy this and take all your time over there and stuff, but that's something that mm-hmm. some of these Silicon Valley type companies, can do. So, Tesla's a little different that way. Yeah, I also always, complain that a lot of things that you get LBOs that make a lot of money are basically things they could have carried out while being a public company.
Of course.
Yeah. And
mm-hmm.
and you read books about behind the scenes things all the time, and a lot of it is, they know what they need to do, but they're not going to do it while they're a public company. And Twitter's definitely one of those things. So,
mm-hmm.
Yeah.
Got it. Cool. Well, we could start working through some of these on Twitter and see what we come up with. Let's see. Okay, number one, cash tag Jeff, no elevator pitch needed. There you go. What's the snap judgment on that one, Jeff?
We approve of that.
There you go. We do approve of that. MPX, manufacturer of boats, mix between more/less profitable large/small boats. Free cash flow has grown much faster than assets over the last half decade. Return on equity, 20+%. Raw materials, inventory build roll-off in 2023, 2024, plus, and then he says, sticky price of premium boats may lead to sustained margin expansion. Have you ever looked at a boat manufacturer?
Yes, I have. So let's go to Quick FS and let's look at Marine Products Corporation.
Yeah, I think this one usually screens because it usually looks cheap. And yeah, I've seen this one before, but let's see. Marine Products Corporation designs, manufactures, and sells recreational fiberglass boats for the sport boat, sport fishing, and jet boat markets worldwide. Let's see. The company sells its products to a network of 206 domestic and 92 international independent authorized dealers. Marine Products Corporation was founded in 1965 and is based in Atlanta, Georgia. PE 10 times EBITDA sales, 1 time. 10-year margins on EBIT. Median margins 10%. Return on equity 22%. All looks well. Assets over the past 10 years, the CAGR on assets about 2%, but the CAGR on revenue 11%, EPS 17%. The gross margins have gotten better.
Yeah, so
gone from 18 to 23. Yeah.
So I don't have a lot to say about this one because it's the same kind of thing. I mean, look, the share turnover is fairly low. The market cap is nearly a micro cap, so it is New York Stock Exchange listed, but it's the kind of thing we would look at. These things always remind me of the boat companies, the same as basically the mobile home companies, right? So the thing is, your gross margins aren't usually too big, and they're not even all that incredibly stable. But in a good year for the industry, the operating profit that you make is really good. So you can see here, for instance, that based on return on invested capital, your turns are like a little over 2 times. So you're able to generate value because your margin on average is like 10% or something. But of course, your turns and your margin are both being affected by the total scale that you have there. So if you see, let's see, starting in can you see on the graph? Can you see return on invested capital in 2006?
It was 21%.
Okay, and then 2007?
16.8%.
Okay, 2008?
8%.
Okay. So if we look, then if we go over to about, let's see, it would be so from about 2008 to about 2014, I would say, the return on invested capital, it was negative for 1 year, but it's they're not really earning their cost of capital, or they're not really getting a return that's going to result in a price to book over 1, in those years. So what you're talking about is outside of those years. So like in this 20-year period, it's the 7 good years before then and the 7 good years since then where you're getting all of your return. And I say 7 good years. I mean, it's been 10 years where it's been getting better and better, but it was a little low in the first part of that period. So, of course, you're worried that you're headed into a recession, right? And if you are, could it be a few years of poor returns? We could probably check out like credit risk and stuff like that first, is what we should do, is to look at the balance sheet, just make sure there's no chance of problems that way. So
they have pension liabilities.
Okay,
but that's about it.
So I mean, pension liabilities are actually we'd have to look because they're only putting the liability of the pension in the excess of the plan, the liability in excess of the plan. So it's always a slight risk. You have to read, the actual description of it. But basically, you see that current assets are much larger than total liabilities here, right? What are current assets?
Current assets are 83 million. Let's go to the quarterly, though, to get updated version. Total current assets, 125 million. Total liabilities, 45 million.
Right. So that's great. The only thing that is an issue is what we call quick assets are a little tighter. So if you'll notice, current assets, which is what we normally talk about, the problem is that they're inventories is a large portion. Inventories are over 2/3 of current assets here. So,
And what is that? Boats?
yes. Yeah.
Exactly.
So,
Yeah.
so presumably, and because they have dealers and stuff, that could be partially finished things. It could be whatever. But obviously, when you're going to sell it, you can see that that's going to be in a slowdown. You're going to have both worse margins, but you're also going to have a difficulty in turning inventories into cash. So that's just something to keep in mind, that the picture isn't quite as good as it looks that way, to be a little careful with that, but it's still pretty good. I'd say that, I'm not too worried about that balance sheet, because even just cash and accounts receivable are covering most of everything. And the liabilities are really pretty good, types of liabilities, right? They're not really financial liabilities. We talked about pension liabilities. Pension liabilities are one of the better financial liabilities you could have. It's not stuff like short-term debt, like bank debt, or even long-term debt, which I would prefer it be trade things and all that, which it is. It's accrued liabilities and accounts payable and all that. So it looks really good that way. Let's look at the cash flow statement.
Sure. Cash flow. We could go back. Do you want quarterly or annual?
Yeah, let's look at annual. So quarterly, we can see in all but one period they generated. Yeah. So basically, it's change in working capital creates the issue, but otherwise they're highly cash flow from operations generative. So we notice, for instance, that property, plant, and equipment is very small at this company. They carry a huge amount of inventory though. So if we look at the overview, maybe we could get a better idea of that. So I could just connect these ideas here. So if you look, what is revenue recently?
About 300 million, 298 million in 2021, 240 million in 2020. 2019 was 292 million, 2018 was 299 million.
Okay. So what we would normally do is I would look at cost of goods sold, which I can calculate here by you just take revenue minus the gross profit. And so we can see here that we're talking about, what is that? Is it 230 million? What do we have there?
Ish. Yeah.
Yeah.
Ish. Yeah.
Okay. So around 230 million or so. And we know the inventories were, 80 some million or something, right? So that means that you're turning it several times, almost, 3 times a year, which is really fast. And then property, plant, and equipment is totally insignificant at, what do we say, 14, 15 million. So the balance sheet really consists of these inventories and how quickly you're moving them. The one thing that's kind of tricky is obviously you have to kind of research this. Is there an issue where you would be slow to see in the company's results any slowdown or pickup in sales because they go through some sort of dealers or something? And so that's an issue here with Miller Industries, some other companies like that. You'll notice that it may be that you can see a slowing down in terms of sales to the actual customer faster than you can see it at this company. And so that's a question of where it is along that you can judge. So you would want to look for signs of that, I think, at the dealer level, and there are probably some data that you can find places about hints about sales levels of those kinds of things, but also you could do some scuttlebutt. So, we know why the price is what it is right now. People figure this is the peak of the cycle, presumably, but it's a very good business. I mean, in terms of it really does generate a lot of money. But I'd also say, like I said, the mobile home thing and stuff, it's a better business than people think, in that on average over a cycle, if you survive and everything, you do pretty well, because in the good years, you generate a lot relative to your capital. It's pretty capital light business, as we saw here. All you need here is a bunch of inventory. There's not much else to this business.
It's kind of like the steel nets that we've spoken about on the podcast, where you get that one good year and you make 6 times your money.
Mm-hmm. Yeah. So, and that was probably a terrible period that we're looking at there, that we're judging it for in the financial crisis. So you would figure that normally the periods wouldn't last as long. We might have a period that's as sharp at some point, a decline in a single year that's like the financial crisis, but it's unlikely that we'll have a period where the recovery takes that long. That was many, many years. So it's better part of half a decade just to get back to sort of a normal level. I'm not sure that we would normally expect the lingering effects of a recession to be as bad as that. Even if we might expect hiking interest rates all the way up and stuff might cause a really bad 2 years or something. We don't think that would cause, a bad 7 years or whatever we had here.
All right, let's go to the next one. VEEV, Telefonica Brazil net cash acquired a distressed competitor. Assets cheaply, roughly 3 times EBITDA, 10% dividend. Fast growing digital payments, B2B biz for free under the hood. I don't know how much we could do from QuickFS, but we could look at it. $12.1 billion market cap, $11.9 billion enterprise value. Let's see. So they do telecommunications in Brazil. PE 11 times, EBITDA sales 1.3 times, EBITDA free cash flow 6.5 times.
Yeah, I mean, it doesn't look good on the numbers that we're looking at. Obviously, the things they said in that tweet make it sound good, and we may be seeing mostly numbers that are misleading us this way in terms of what the company looks like now. But the numbers based on what it looked like in the past wouldn't really justify a price to book of close to 1, which is what we're seeing here. I'd say it should trade at a much bigger discount to book based on its past 10-year record, but maybe the future will be very different. And there's non-quantitative things that are attractive about it, but not what I see in these 10-year record.
Okay, we can go on to the next one. Netflix, winner in the streaming world, 100% aligned management team, top of mind share for consumers. We could look at Netflix. You familiar with this company? Just a little bit. All right. Mm-hmm. Market cap 139 billion, enterprise value 147 billion, EV to sales 4.7. Gross margins, free cash flow, valuation is kind of, we talk about these often on the podcast. Interestingly, the price has come down a good amount this year, but I believe it's up, let's see, where are we at right here? $308 per share. Yeah, it's up from its lows this summer. Down from almost 700, which is crazy. Do you have any thoughts on Netflix even? Where would you even start with this company?
Yeah, just the same concerns, but that we're talking about with the industry. This whole industry of focusing on streaming stuff has to dial back their investment levels because it's not economical the way they're doing in the competition they're creating. With all the streamers competing with Netflix, I am worried that they're locked out of a lot of good studio content. So they're now directly competing with basically everyone except Sony. Sony's the only one that'll sell to them. So they have to create a lot of the content themselves. I think before they were built a lot on content from studios that were willing to sell to them. Now apparently the studios won't sell to them. In the US box office, I guess somewhere between 50 and 85% of all box office stuff just will never be sold to Netflix, so that they'll never get it. So they certainly can't build much in the way of movies. What they can do is, obviously do a lot of creating TV and stuff for themselves. And that's kind of expensive, but that's what everyone's doing right now. So I'm concerned about the whole industry in terms of just the economics of it isn't looking good when the whole industry is pursuing this kind of behavior. So we got to kind of see a change in that behavior.
What needs to happen to justify a return at these prices? Like, let's say your hurdle is like 12%.
Well, it's hard to say. The issue if we get into let's go to the cash flow statement because this is the tricky part with Netflix. So if you see the operating profit situation is good now. So if you just look at it on that basis and really trust those numbers, then you would think that things are pretty good. However, if you look on a cash flow basis, you're pretty concerned. And that's because the cash flow that you're seeing, the depreciation and amortization is film inventory amortization, as well as you have things for rights stuff. But generally, it hasn't been cash generative. But it's reporting good earnings numbers. It's also a difficult thing because you can't really tell from a financing perspective how much risk they're taking because with these companies, they've probably signed up for a bunch of stuff in terms of having to promise payments into the future. And obviously they disclose those things, but they're probably pretty large with any of these companies now when they're using anyone else's content.
Yeah. So like, let's say, okay, they could do $2 billion in cash flow and let's say PP&E could be, almost 500 million, but let's say like in free cash flow, you could do $2 billion. Well, it's at 100 Yeah,
right?
140
so 70 times.
billion
Yeah.
market cap.
Right. So that's the issue. That it's at 70 times their best free cash flow stuff.
I was gonna say, so here's an interesting question, right? What would a private buyer pay for this business, like a Disney, if they could?
Yeah. I think there was a time when they would have paid a lot for it. Is even just because they felt that they needed to own it. Let's see. I mean, I looked at the company seriously when it was about 80%. I mean, this is going back. It's probably going back not quite 8 years, something like that. And it's probably up like 6 or 7 times since then, I would guess. I'd have to, the share counts change and stuff, so it's a little trickier, but that's my memory in terms of market cap and EV. And at that time, it looked realistic to me where I said, well, okay, what would one of these big entertainment companies pay for it? Now, obviously, it's not a target for any of those.
I'm just trying to think, how do you even underwrite a return in this company if you were to invest today? I don't know what type of math people are using.
Yeah. I think they're looking at the profitability, at the reported net income. Or they might be looking at EBITDA, though that's very confusing.
That's a tricky one. I don't know. The way that I think any rational person would look at it, you're still paying a pretty hefty premium.
Yeah, I mean, look at let's put in Paramount to give you a comparison here, for instance. Yeah, Paramount Global. Yeah. Right. So on an enterprise value to sales, Netflix is 5 or 6 times higher. So Paramount's heavily has a lot of debt, but to sales is the most obvious way of doing it, I would say.
EV to sales is 0.8. And what do we say Netflix was, like 4?
Yeah, I mean that's a very high price to pay for a media company, for a entertainment company in terms of price to sales. Just because of what that means in terms of margins, right? So let's say you want it to be, you're comfortable at, that one day it'll be durable and it won't be growing that fast or whatever, but I'm willing to pay 20 times free cash flow or something. The problem that you have there is that if you're paying such a high price to sales, then it's hard to get a good free cash flow yield, right? So, yeah, I think it's pretty expensive given the economics of the business right now. I thought before this big ramp up in the competition from others that wouldn't be the case. My concern is not on the side of like Netflix not getting enough subscribers or the idea of competition on the demand side. I think that lots of companies you can have a Netflix subscription, a Hulu subscription, a Disney Plus, and whatever. It's purely on the side of how much the content will cost them and how much of it is accessible to them. They used to be able to buy content from others. Now they can't. And, they're in an arms race with others that costs a lot of money. And so for the whole industry, I would just say that I'd have less faith in everyone's ability to create value going forward unless the costs of these things go down in terms of how much content you're using relative to the number of people that you have subscribing, how much you're spending on your own content or content that you're buying.
Got it. Cool. Let's go on to the next one. This, I think, got the most engagement from people. SMTI, 50 million rev run rate, growing 50% plus, organic with plus 80% gross margins, disrupting the wound care / surgical space, and not a single analyst on the earnings call. Okay. SMTI. Sanera MedTech. Market cap about 300 million, EV 288 million. Doesn't look like they generate much in earnings. EV to sales 7.7. This is not a you wouldn't look at this probably the way you look at a mature company. Let's see, they're based in Fort Worth, Texas.
I was just gonna say you could go to the quarterly so we could see that and we could point out some of the things that are interesting.
Okay, quarterly.
So if we look at Well, the revenue growth is very, very high, and the gross margin is very high. So there's the potential. This would be the kind of company where it's okay to pay a very high price to sales, for instance. So like the fact that this is 8 times is not as crazy to me as when I say that, you know, something shouldn't have a very high price to sales because it has a very, very high gross margin and it's growing very fast. I can't evaluate the business, right? Because I just don't know anything about the medical sorts of things like this that we're talking about. But if you're a believer in it, then yeah. Obviously, when you have gross margins of 80, 90% and you're growing, you know, you're doubling your sales lately you're doubling your sales like every year or something, then, you know, you can justify almost any number.
Let's look at SMTI on OTCM. Oops. Yeah, so it looks like came public, or however it came public, $4.50, and it's just been kind of hovering around here since 2021. I wonder if they've diluted. Let's see their income statement. Yeah, it's gone from about 6 million to 8 million.
Yeah, and their operating expenses have gone up a lot. If you look like, say, quarterly, for instance, if we look quarterly, you can see what I mean. That your operating expenses have gone up a lot. So, you know, you've managed to like triple operating expenses quarterly over, you know, since COVID started basically. But that's not crazy because you've also almost quadrupled your gross profit number. So, and if that, it depends on what that is. If that's a lot of, you know, business development, sales type activity, then that makes a lot of sense. You know, it's just like when we talk about Celsius or something. This is so small compared to that, and the gross margins are double. But yeah, it's similar to that in that if you grow fast enough, you can outgrow the fact that you're growing your operating expenses really fast. It's probably a company that's pursuing growth really aggressively. But I mean, it's something to look at. I don't know anything about it and stuff, but it is a total difference when you have a fast growing company that has gross margins that high.
But for you, it would be hard to analyze stuff that's, you know, in the medical field versus like a Celsius where you understand what the business is.
Right. This is probably one that's not for me. But if it was based on the numbers and someone said, here's this private company, do you want to invest in it or whatever? The fact that it's growing very fast but has incredibly high gross margins, you know, it would be the kind of thing that you would put at the top of the pile in terms of just, you know, that it's not impossible that something like this could be worth a lot. You know, makes sense as a lottery ticket compared to some of the things that people say. You know, a lot of things that people bring up may be fast growing, but their core economics aren't that great. Here, it looks like the core economics could be a lot better, but you know, it's hard to say. We're still talking about something that's been losing, you know, money and all that and growing expenses in the past. Though that's perhaps justified if you're growing like they have been.
Why does it have to be private for you to look at it like that?
Well, I just meant if someone's saying, here's an opportunity to invest in this thing. I think, well, why I would say that is I don't know how much we're able to really evaluate it as a company this early on. I would say, yeah, I think you should, if you really consider this, consider it like a venture capital investment. That's what I would say. It would just be a pass for me just because I don't feel like I'm ever going to be someone who's going to understand nearly as much as the other people investing in it about the medical. You know, it's just a field that I'm not going to be able to invest in, I feel like, because I'm not going to know enough about it compared to others.
Got it. Let's see. BECN not exposed to new homes, with majority of biz coming from repair and remodel. Highly fragmented industry with just one other major competitor. Pretty strong management team. BECN. Let's see. BECN. A roofing supply company. Together with subsidiaries, distributes residential and non-residential roofing materials and complementary building products to contractors, home builders, building owners, lumber yards, and retailers. Operate approximately 400 branches in 50 states of the United States. It's 6 provinces in Canada. BECN Roofing Supply Inc. was founded in 1928 and is headquartered in Virginia. $3.6 billion market cap, $5.4 billion enterprise value. Price to earnings, 8 times. EBIT to sales, 0.7. 10-year median margins on EBIT, 4.8. If you look at their gross margins, I'd say they've been pretty stable.
Mm-hmm.
The revenue CAGR has been phenomenal. 13.8% going from $2 billion in 2012 to 6.6 in 2021. Geoff, what are you seeing?
Yeah, so obviously don't know about that if that's because of the cycle, and we're just seeing that 2012 is about the bottom in terms of, home activity last time. Let's look at the balance sheet.
Okay. Current assets, $2.6 billion. Total liabilities, $3.4 billion. Generally, you like to see that current assets can cover total liabilities.
Mm-hmm. So let's look at cash flow stuff. Yeah.
They've grown by acquisition too.
Yeah. I think for a company that's in maybe a very cyclical industry, now maybe it isn't as cyclical as I might think, we'll see. It might get a little uncomfortable in terms of the balance sheet and the cash flows that we're seeing here. This is an incredibly strong position that way, I would say. But we don't know when the maturities are for things and all that. But let's see. Maybe they've acquired a lot of stuff, so maybe doesn't help us out that. I was going to say, can we look at the download financials?
Sure.
One to see if we can see years before 2012.
Yeah, let's pull it up.
Yeah, I'm just questioning how. Don't doubt that it's very successful in a good year, but I'm just questioning how bad things will get in a bad year.
Okay, so we pull up the income statement. If you are a member of QuickFS, you could download 20-year financials. You could tell them that you came from Focus Compounding when you check out. That would help us out. But let's see. So
maybe key ratios are fine for me. Yeah.
Key ratios.
Yeah, like ratios. Yeah. Yeah, if we just zoom into those early years, what was the situation there? So not bad. Not bad at all that way. Why has the situation been so bad in terms of operating margin lately? Okay, well, let's look at the cash flow statement.
Okay, zoom in.
Yeah. Okay. It looks like it's changed a lot recently, right? So I think we're seeing some major acquisitions, obviously, just sort of a few years before COVID. And then we're also seeing a really big build in like working capital lately, which might, like really lately. So that could reverse, obviously. I guess that was mostly because it reversed in such a big way during COVID. The activity dropped to like nothing. Yeah. It doesn't look as cyclical as I thought it would, so that's not bad. It's been a consistent earner over a long period of time. Present day situation is not as great as I would like in terms of like the balance sheet and all of that, but it looks like, we can see here times when it got really bad in the past weren't particularly difficult for them at all financially. So, if this company's like it was back then, it's not a problem. But yeah, what I was kind of saying about the balance sheet and stuff is I'd like to see more in terms of like quick assets and stuff and less in terms of debt if you're going to have a company that's highly cyclical, but maybe they don't think it is that cyclical because the past record doesn't look that bad that way. I would have thought that they would have cash outflow during the bust, and on a free cash flow basis, they did a little bit, but basically they continue to generate cash flow from operations and even really free cash flow throughout the housing bust last time.
Mm-hmm. Interesting. Well, it's a $3.6 billion market cap, but is this something that you would be interested in learning more about? Is it an industry that you just or the business that it's in is something you would stay away from? Is the price not as compelling?
Yeah, I mean, it's probably an industry that I would stay away from, probably because I don't feel like I understand that well. It had a particularly good margin year in the last year and a particularly bad one the year before that, obviously. So the operating margin is actually very unstable, but it's been positive. So throughout the whole period we looked at.
GFG, online retail for fashion in emerging markets. Net when accounting for the sale of the Russian business at 100 million. Let's look at this. Russian business. GFG Resources, is that the one? Let's see, maybe not. Metals and mining. I don't think I'm pulling the right one. GFG online retail. Yeah, I'm not sure about that. Okay, we can go on the next one. PL. Building an Earth monitoring platform akin to Bloomberg Terminal on top of a proprietary data stream from 200 satellites imaging the entire Earth's landmass. Next satellites are successful. We have the ability to track up to 80% of all emissions by this source. Founder led. Every day is what he meant. Okay, PL. This is Planet Labs. Okay. Aerospace and Defense, $1.4 billion. Probably could not evaluate based on QuickFS. Actually, not probably. Certainly could not evaluate based on QuickFS. Look at their balance sheet. They probably just raised a bunch of capital. Mm-hmm. Any thoughts, Jeff?
No thoughts.
Here's a stock that you've looked at before, CODA.
Yes. Real-time
underwater sonar / imaging technology company. I believe you guys covered it a while back. That is correct. When trading volume was unusually high. That's also correct. What was that, like 2018 maybe? 2017, 2018? That has changed, and I'm curious what Jeff thinks about it. Thanks.
Mm-hmm.
So did this become like a pump and dump microcap? What happened here? You remember this? Let's look at the chart really quick.
I mean,
remember like the share turnover like went berserk?
Yeah, I mean, I know that some people all brought it to my attention and asked me to talk about it and stuff, hoping that it would get more attention for it. I don't know if that makes it a pump and dump.
Oh, really?
But yeah, but I said before,
well, if they're coming to you, Jeff.
It happens sometimes where they say, can you talk about this and stuff? Because, I want to get more attention for this stock and whatever. And, usually people aren't as forward about it as that. But, it's good for them to be honest about it.
Yep. They develop and sell underwater technologies and equipment for 3D imaging, mapping, defense, and survey applications in the Americas, Europe, Australia, Asia, and the Middle East, and Africa. Let's see. I'm looking at the share turnover, 41%. I believe at one point when we looked in like 2019, it was like 300% or 200%. It was just going crazy. Yeah. 10-year median margins on EBIT, 20%. 10-year CAGR on revenue, 3% going from 21 million. Looks like we're still at 21 million, so I don't know what's going on there. Gross profit's gone from 12 million in 2012 to 15 million today. Operating profit's gone nowhere. It was it's actually gone down. 6 million in 2012, 4 million today. What are your thoughts, Jeff?
Yeah, I think it's interesting. I don't know enough about it and about whether they'll get more sales and everything, but it's pretty legitimate for a company this size. There aren't that many companies that are this small in terms of market cap and everything. We're talking about 74 million market cap, and the EV is even smaller. And that make money, regularly. They had cut expenses a while back so that they are actually somewhat, very profitable for a company that size. So it's very different from most of the things we talk about where they're fast growing or whatever. On the other hand, obviously it hasn't grown. Sales are very lumpy. But it has things, even contracts with like, defense thing or whatever. So like, it also sells very few units sometimes, because if you look at the actual revenue and then you divide by the price that we think that each unit sells for, the actual number of units they're selling is quite small, because these are pretty expensive, products,
Mm-hmm.
So really,
was it someone involved with the company, like a large investor that brought it to you?
No.
Okay. Just clarify that.
Absolutely.
Okay. So
not.
was it management?
No.
Right.
No. But just a few different people over time have done it. So, which is not surprising because it had an incredible share turnover that we talked about. So, just microcap investors that are, but there's companies we talk about in the same size thing where no one ever mentions them to me. And, yeah. So there was at least a time in this company where it had a little more buzz around it with investors, I guess. Yeah. I mean, I don't get a lot of people coming to me to talk about ARC or Flanagan's or what else is in this size,
Yeah.
Yeah.
Mm-hmm. Got it. Someone sent a email for this company. Was it Viva Systems Inc.?
Mm-hmm.
Ticker VEEV. $26 billion market cap, $23 billion enterprise value. They referred to it as a growth stock. It's a pretty big growth
Definitely
stock.
A growth
when you look at the revenue,
Yep.
10-year CAGR 40%, going from 130 million in 2013 to 1.8 billion in 2022. You've had gross profit go from 73 million to 1.3 billion in 2022.
Mm-hmm.
Operating profit 30 million to 505 million. Good Lord, where do you even start with this, Geoff? EV to sales 11.6 times. You had said you would never pay more than 10 times for sales for a business. Here we are. Strong return on equity numbers, strong return on asset, return on invested capital. What do they do? Viva Systems provides cloud-based software for the life sciences industry in North America, Europe, the Asia Pacific, the Middle East, Africa, and Latin America. Looks like they do a CRM. So it's kind of like, what is this, like the Salesforce for life sciences? Let's see, incorporated 2007, headquartered in Pleasanton, California. Where do you even start with this, Geoff?
On the, financial results, it looks like everything that you'd want to see. On the price, it looks too, expensive for me to get interested. So that's kind of the trade-off that you have there. But it, it looks really good on all the sorts of numbers that we talk about, whether that's, any of them, gross margin numbers and stuff. Like in terms of something that grew and that had very good numbers as it grew, all the sort of quality checks on it. This looks good on all of those. Again, it's a kind of thing that I don't know. I feel like I wouldn't know this well enough. It would be too far outside my circle of competence. And then I also feel like just price to sales and stuff is just too high for me. But the numbers we see each year, if you look at this, if you look on QuickFS at this, you'll see that it has a pattern of a very successful company that creates a lot of value over time that way. So that doesn't necessarily mean it'll be successful as a stock for people who get in, once you already have a high price. And it may have been at a high price for a long time now. What's the price to sales been historically?
18 times, 12 times, 7 times, 11 times, 13 times, 18 times, 20 times. So it's always been pretty high. Let's look at the stock chart. See what this looks like. It's going to be beautiful over the past 10 years. It's been pretty good. $24, and then they had a high of $330, and now it's pulled back a little bit. So we're at 160-ish, 165 today. So
yeah, and it's
but you're still at 11 times sales.
Yeah, absolutely. Yep.
Which is tough. Okay, let's see. I heard Geoff talk about CNK in 2020. Stock is the same price now, but improving conditions. How does he think about the debt of $2.4 billion? Balance sheet risk to the common shareholders. I see debt is junk rated. Has Geoff invested in equity of a company with junk debt? Would love a snap judgment on CNK. Okay. No stranger to the pod. Cinemark. When's the last time you've been to a Cinemark, Geoff?
Last week.
There we go. Once a week, baby. That's right.
So, it's definitely risky that way. And I think I don't know if we've talked that much about it that way, but yeah, it is risky in terms of the debt situation. It has rent and debt, that, does present a problem that way. It has no safety in terms of the balance sheet. And unless it can get, attendance numbers up, it's not going to have enough cash flow to handle things very well. It also, unlike some other companies and stuff, can't sell things off or anything like that because obviously everyone else in the industry faces the exact same situation that they do. They have no diversification to anything else. They're pure play. Whereas like Marcus or something would be easier that way. I mean, if you want something that looks like Cinemark but has a ton of safety, it's Marcus.
Is that like if you want to get exposure to theaters, but then they also have this real estate?
Yeah, I mean, we can
as well.
Yeah, I mean, we can like say which ones. I mean, like there's other publicly traded companies that are in worse shape than Cinemark in terms of, I would say, the credit risk. And then there's one that's safer, which is Marcus. So I guess for U.S. based operators of movie theaters, you have Reading, Marcus, Cinemark, and AMC. You then have other ones that might own some things, but they're basically from around the rest of the world. I would say that of those, Cinemark is kind of in a better position than the others that we just mentioned, but it's obviously in a worse position than Marcus, which is diversified in that it actually owns like excess land on things like, theaters that it had that actually own the theaters. And then sometimes was stuff that they don't need anymore. And then it also owns outright some hotel stuff, and it manages hotels. So, if you're looking for safety that way. Yeah, I think that's the real issue here is if you're going to get diluted or you're going to have other problems that way. On the other hand, from a cash flow perspective, I think that anything before COVID wouldn't be a problem, right? So the issue that you have here is just whether you ever recover from COVID. I don't think the situation is as bad as it is with the cruise lines, but so far the recovery has been weak. So we'll see. And now interest rates are higher and maybe financial conditions will be tighter, which some people were asking about. There's a lot of cash flow from operations historically, though. So there exists the potential to, let's look at, so what do we have we can just look at in terms of their debt. We could see in terms of, you got the balance sheet, but then you also have, we'll use the balance sheet.
Short-term debt, $22 million, long-term debt, $2.4 billion, and then they have capital leases of a little bit over $1 billion.
So they have $1.8 billion in net debt, right? Debt minus cash. And then you have capital leases too. Before COVID, cash flow from operations used around $500 million or something. So I don't think that's a huge problem having 3 or 4 times your cash flow from operations and your debt. Since COVID, you have a real problem, very real problem. And that's an issue for any of the movie theater companies if they don't have something else. So, but that's also the problem, honestly. I think we talked a little bit about that, but like if it's not going to recover from if you're not going to see recovery back to the levels that you saw in movie going before, then this is not a good stock because it's volume based. There's little that they can do to fix that problem. So, I see it as a serious problem. Mm-hmm. And you have to bet on that working out. And it's been very difficult for them so far.
Have you ever invested in a company with junk debt?
Have I ever invested in a company with junk rated debt? Well, most companies I would say that would be junk rated would normally, I would say would normally not be big enough to have debt that's rated that way. Actually, Manager Accounts held a stock where debt of a subsidiary was junk rated. It actually had a rating, although not from a major credit rating agency, but it would have gotten a junk rating. That's NACO. So that's actually not debt that's recourse to them, obviously, but that would definitely be junk. Yeah. I think, you're very leveraged. And so you have the problem that it might not. I mean, we did talk about this where it said like, and I would stand by this part. At this point, we can look up. So this is a $12 stock right now. We can look up like Six Flags or something. I think that you don't have to take the risk of buying like a movie theater company right now, in the sense that I don't know if Six Flags is up since then, but it's a similar size company, similar debt situation in a lot of ways, and a lot more reliable that people are going to go to regional theme parks or to attractions. So there might be more upside in Cinemark, but I would say something like Six Flags or any of the other attractions ones are a better bet, the parks, than are the movie theaters. A bit safer bet. It's very bad. I mean, we'll see, but I don't know that theaters, some of them will, but the theaters and the cruise lines will ever get out from under what happened with COVID. The cruise lines obviously took on way too much debt and everything, and I don't know how they can work their way out of that. And the movie theaters, there hasn't been enough of a recovery in movie going. Although we should say, like, Cinemark's generating cash flow from operations lately and positive EBITDA and stuff.
Are you confident, or do you feel bullish that it will get back to pre-COVID numbers in Cinemark? That the volume will come back?
No, let me put it this way. We'll see. I'm not a credit analyst here, so but if we compare something like Cinemark with something like Carvana or something like that, so these are, Carvana's bankruptcy imminent, or like when we talk about Tesla when in 2017 or whatever, saying like, look back at the record and what it looked like then, and it turned around and so they had something positive there. I think Cinemark will be run in such a way that they're going to try to do everything they can to generate enough cash and to pay their debt. We talked about Discovery, Warner. It's huge. It's an incredible amount of debt versus what they're able to generate right now. And the only thing that's generating is the Discovery side of it. So it's a bad situation now, but they have a really long way to work it out in terms of how long till a lot of that debt is due. The fear with some of them is I would have more fear with companies that aren't focused on just generating cash and not expanding and everything. So I have less concern with, not less concern. I would rather be investing in a company that's doing the sorts of things that in this sort of situation that Cinemark's in, and I feel that you're better able to evaluate it. However, I look at the box office things, and so far, it's it has not gotten back to what I would have expected by now. It is mixed. The big blockbuster movies, I think there's no effect on it right now. I think they're doing exactly what they would do before, but there's absolutely huge declines in anything in between. So horror movies, I think, are doing what they were doing before. Blockbusters, I think, are doing what they were doing before, but romantic comedies, straight dramas, small thrillers, things that were more middle-aged audiences going to, and not people who are particularly young and social and all those sorts of things. The numbers are just not good when you're relying on a more diverse audience in terms of age and things like that. So, it's bad. And I think there's pretty strong evidence that it's significantly worse than that. So we'll see. But, and they need all sorts of movies all the time to be able to fill up. So, but that's kind of what we talked about before, is if it'll recover or not. I think if it recovers to where it was before, I don't see any problems. I mean, I shouldn't say I don't see any problems. I see it's a heavily leveraged movie theater company, but I mean, I don't think it's really a problem. They generate between
3 to 4 times cash flow.
Yeah, cash flow from operations, and I think they could really skimp on the capex. The theater I go to hasn't had capex in like 15 years probably. So it depends, but I mean, they're spending a lot on some things before, and obviously all their competitors and stuff are in bad situations too, and they're not going to spend a lot on it. So But yeah, no, I mean, there's no doubt that it is definitely risky that way. And maybe we should pay more attention to I should pay more attention to that when describing some of these companies in terms of the risks, because they're sometimes very different. Some of the ones that we went over just now, some of them have real risks of credit issues there, and some don't. And we kind of go over sometimes the checks on what that is. And we can do that even now with Cinemark, where you can see if we go to the balance sheet to show you what kinds of things we check. But as you can see, total liabilities are very high, right? So the first thing you'd start with is that total liabilities are incredibly high versus current assets and versus quick assets. Having very high quick assets and current assets relative to total liabilities is the best thing that you can have. Having low financial debt is something that you want to have. And then there's also the issues of like, which people spend a lot of time worrying about the exact maturities when they happen and all that. That is an issue, but you know, in most markets you can kind of work with that if you're generating a lot of value, right? So, you know, maybe not in the middle of COVID or something, but normally you would be able to just pay higher rates or something and be able to refinance things if you're generating a lot of cash flow. The issue that they have, if we look quarterly, we can go look at the quarterly cash flow to get an idea, is that they had negative cash flow from operations in many quarters recently. And I think if we look, in fact, they have not, I believe this is true, right? Yeah. They've not had 2 consecutive quarters of positive cash flow from operations. Yeah. So since COVID started. So I'd say that's really just the issue that we're dealing with here is the level, you know, I mean, I would say in general, and we can look annually now, but because this is a slightly seasonal, you know, business, there's some seasonality to it. But in general, if you're having negative cash flow from operations, you don't want to invest in the equity. You know, people do that, venture capital and all these high tech things and stuff are used to doing that. But I just don't think that anyone listening to this podcast should really be investing in companies that don't generate positive cash flow from operations. And certainly you don't want to have debt and negative cash flow from operations ever. And that's the situation that they were in when they got out of COVID. But also when we look at it now, they're still like 50% or so below where they were before in terms of cash flow from operations generation. I don't think it's a problem if they were back to the levels they were before COVID, but if they don't get back to the levels they were before COVID, yeah, I think it's a huge problem. And it's a huge problem for the stock, even if it didn't have debt. If that debt we would say was equity instead of debt, I still think it would be a huge problem because then you just want to be earning enough money. So I do think that's.
Do you think supply needs to come out of the industry?
Yeah, I think
theaters
about that. That's the problem. That's the why it didn't come out. Yeah. So, I mean, you had a very weird situation where financial conditions got incredibly loose and they shut down all your theaters. So, that didn't help anything, those two things, right? So like the demand, possibly permanent destruction of demand for some kinds of movies, at least for certain kinds of moviegoers, happened because of COVID and the restrictions on it and all of that. You know, what I mean is that having the restrictions got people in different kinds of habits, and the streamers focused on doing that and everything. So that's what really changed things. Not that people were afraid, I'm going to get COVID, so I'm never going back to a movie theater. Obviously, people are not thinking 2-3 years on that they're worried about getting COVID when they might be vaccinated and can wear a mask and whatever. That's not the issue. The issue is that it changed people's behavior for viewing for certain kinds of people who are lower total movie goers, but a big part of the population. Yeah. And then the issue that they didn't go bankrupt, these companies, right? So you at the same time were able to refinance things, even like, remember, AMC like issued stock and all that, right? So yeah. So normally when you have a devastating downturn in an industry, you don't have like really easy financial conditions, right? So like if all home builders are in terrible trouble or something, you don't have something happening where everyone's willing to lend a lot of money to home builders or to buy a newly issued stock or whatever. And we had a combination of those two. Yeah. So they weren't able to get, supply supply out of the industry that way. And they're even like understaffed and have higher costs and stuff when the theaters than they used to be. I think we've talked about how I think they'll have less in terms of operating hours and things like that because they are pressured in terms of costs. I mean, one thing is they haven't wanted to raise prices because they're scared that people aren't coming back to the theaters, that even when they're having wage increases and stuff like that, they're trying not to, have certainly less than other industries. They haven't been passing on the inflation the way that they normally would be in a high inflation period. So, but yeah, no, it's certainly very risky that way. But I really don't think that it would be risky at the levels that it was at before. I don't think the company was in a particularly risky situation before then. I think it's purely a result of COVID.
Interesting. Hey, you can look at AMC on this chart. Their crazy run through 2021.
Yeah, and
that bubble has popped.
Yeah, and obviously, if they have the future, I mean, I've talked about it before that sometimes with the company, if they, I've been invested in companies where I'd say if they happen to have that sort of thing happen, run into trouble at the same time that they had difficulty just in the economy overall as to it being tight getting financing, then they would go under. And then at the other hand, if it was particularly easy, then they survived. And that's the situation they have with some of the companies like this, is that if things get a lot tighter over the next, let's say, year or so, then it will make a bunch of different things a lot harder from a credit perspective. But we could see some problems for some companies that were hurt badly by COVID, right? Because things that they could do, it's amazing now thinking about like how Carnival was able to issue a bunch of bonds at like 11% or whatever in the middle of COVID, basically, and what that will look like. Just, you want to guess that a few years after COVID, you want to be able to do it much cheaper than that now, just because of how much interest rates have gone up and stuff, not because you're in the middle of the, having your entire business shut down.
Got it. Cool. Well, I want to thank everybody so much for tuning in with the both of us on the Focus Compounding podcast. If this is the first time you're tuning in with us, be sure to check out all of our content that we put out there on the internet. Go to focuscompounding.com to get investment write-ups from Geoff and a backlog that goes all the way back to 2005. Follow me on Twitter at Focus Compound. It's the best place to get everything that we put out there in the investing universe. And of course, if you're interested in learning more about our money management services, reach out to me at andrew@focuscompounding.com to start that conversation. You can get more info on that on our website under the Invest With Us tab. I thank everybody so much for tuning in with both of us, and we'll see you in the next podcast. Take care.